Welcome back to Qara-Investment. This week, we will uncover diversification strategies. We will exploring following key components in diversification strategy. We will unravel the foundations of diversification, touch on sector diversification, study geographic diversification, dive into the role of market capitalization, understand dynamic strategies for dynamic markets, and finally touch on diversification across asset classes. Quick question. Have you ever wondered how to optimize your investment returns while managing risk effectively? If so, let's embark on an enlightening journey into the world of stock diversification, a fundamental investment strategy designed to balance risk and reward. Picture a seesaw. On one end, we have potential returns, and on the other, risks. The goal of stock diversification is to balance this seesaw, optimizing potential returns while keeping risks manageable. How do we achieve this delicate balance? By spreading investments across a broad spectrum of stocks, sectors, and industries. This strategy enables us to avoid the pitfalls of concentrating all our financial eggs in one basket. Think about it this way. If you invest solely in technology stocks and the tech industry faces a downturn, your portfolio could take a significant hit. However, if your investments are spread across various sectors, such as healthcare, finance, and consumer goods, a downturn in one sector could be offset by the performance of others. This is the essence of diversification. But it's not just about spreading investments. It's also about understanding individual stocks, analyzing their risk profiles, and assessing the correlation between them. For instance, if two stocks tend to move in the same direction under similar market conditions, they are said to have a high correlation. If one stock's price moves independently or in the opposite direction of another, they have a low correlation. By including a mix of stocks with low correlation in our portfolio, we can further reduce risk. There's an old saying in the investment world, "Don't put all your eggs in one basket." This wisdom rings particularly true when it comes to stock investing. By putting all our financial assets into a single stock or sector, we expose our portfolio to unnecessary risks and heightened volatility. In contrast, a well-diversified portfolio is like a well-balanced diet. Just as different nutrients contribute to our overall health, different stocks, sectors, and industries contribute to the health of our portfolio, each playing its part to optimize returns and manage risks. Embarking on a diversified investment journey can be your safeguard against unnecessary risks and heightened volatility. Stay tuned as we delve deeper into the art of stock diversification in the following scenes. How can sector diversification safeguard your investments against industry-specific downturns? That's the question we're going to delve into right now. Sector diversification, in essence, is the strategic distribution of investments across various sectors or industries. It's about not putting all your eggs in one basket, or in this case, not investing all your money in one sector. Why is this so crucial? Because the market is unpredictable. If one sector takes a hit, having investments in other sectors can help cushion the blow. Let's consider a hypothetical scenario. Imagine you've invested heavily in the technology sector, and then there's a sudden tech market crash. Your portfolio is going to take a hit. But if you had diversified and also invested in, let's say, healthcare and finance, the impact on your overall portfolio would be significantly less. This is because each sector responds differently to market changes, economic conditions, and even global events. So while technology might be on a downward spiral, healthcare could be booming. It's this balance that can help maintain the health of your portfolio, even in turbulent times. Now, let's bring this concept to life with a real-world case study. Consider the financial crisis of 2008. Financial sector stocks were severely impacted, but those who had diversified their holdings across various sectors, such as consumer staples or utilities, were better able to weather the storm. Their diversified investments served as a buffer against the financial sector's collapse. But remember, sector diversification isn't about randomly picking industries to invest in. It requires thoughtful analysis of each sector's performance, growth potential, and risk factors. It's about understanding the dynamics of each sector and making informed decisions based on that understanding. So, what's the bottom line? Diversification across sectors can act as a form of insurance for your portfolio. It can help mitigate risks associated with industry-specific downturns and create opportunities for growth in various market conditions. Sector diversification, when done right, can indeed be your portfolio's protective shield. It's a strategic approach that can help optimize returns and manage risks in a world where the only certainty is uncertainty. Why should you consider investing across different regions and countries? That's the question we'll tackle in this segment as we explore the dynamic realm of geographic diversification. Geographic diversification is like a world tour for your investment portfolio. It's about spreading your investments across different regions and countries. It's not just a matter of casting a wider net. It's about strategically expanding your investment horizons to tap into the diverse economic conditions that exist around the globe. Think of it this way. When you only invest domestically, you're riding on the economic conditions of a single country. If that economy takes a hit, so does your portfolio. But when you diversify geographically, you distribute your investments across various economies. This way, if one economy experiences a downturn, your other investments in thriving economies can help stabilize your portfolio. Now, let's paint a clearer picture with a real-world example. Consider the financial crisis of 2008. While many Western economies were grappling with recession, emerging markets like China and India were still experiencing significant growth. Investors with a geographically diversified portfolio could potentially offset their losses in Western markets with gains from these emerging economies. But it's not just about mitigating risks. Geographic diversification also opens up opportunities to capitalize on growth in different parts of the world. Take the technology boom in the United States, the manufacturing prowess of China, or the natural resources wealth of Australia. By diversifying geographically, you can have a piece of these various economic pies. Geographic diversification, however, is not a one-size-fits-all strategy. It requires a deep understanding of international markets and careful consideration of factors such as currency risk, political stability, and market regulations. But with proper research and strategic planning, it can be an effective tool for optimizing your portfolio's performance. In essence, geographic diversification is about creating a well-rounded global portfolio that can weather storms and seize opportunities in any corner of the world. It's about being resilient amidst geopolitical uncertainties and adaptable in the face of diverse economic conditions. Geographic diversification can be your passport to leveraging the world's economic diversity. So why not pack your portfolio's suitcase and embark on a journey towards a more diversified investing adventure? How does market capitalization influence your portfolio's risk and return profile? This question is crucial when considering stock diversification. Market capitalization, often referred to as market cap, is the total market value of a company's outstanding shares of stock. It's a critical indicator of a company's size, stability, and growth potential. Let's delve into the unique roles of large-cap, mid-cap, and small-cap stocks in shaping a portfolio's risk and return profile. Large-cap stocks, typically those with market values above $200 billion, are usually well-established companies with a global presence. Think giants like Apple or Microsoft. These stocks tend to offer steady returns and dividends, making them a comforting presence in your portfolio. However, their size often means they have limited room for exponential growth. Then, we have mid-cap stocks, typically those with market values between $2 billion and $200 billion. These companies are often in the growth phase, striving to expand their market presence. Investing in mid-cap stocks can yield higher returns than large caps, albeit with a higher risk. Lastly, small-cap stocks, typically those with market values less than $2 billion, are often young, ambitious companies. They offer the potential for high growth rates, which can translate into substantial returns. However, they also carry a higher risk due to their relative instability and susceptibility to market fluctuations. So, how do you balance these in your portfolio? It's all about your risk tolerance and return expectations. If you prefer stability, a portfolio leaning towards large-cap stocks might suit you. Want a blend of stability and growth potential? Consider a mix of large-cap and mid-cap stocks. If you're a risk-taker looking for high returns, incorporating small-cap stocks can be a rewarding strategy. But remember, diversification is key. Even within each market cap category, ensure to spread your investments across different sectors and industries. This strategy can help mitigate the risks associated with any single company or sector. Understanding market capitalization can be your compass in navigating the diverse landscapes of stock investments. So, take the time to understand it and use it as a tool to shape a well-diversified, resilient portfolio. How can you adjust your diversification strategy to the ever-changing market conditions? There's an old saying that the only constant in life is change, and this is particularly true in the world of investing. Markets are dynamic, always in flux, influenced by a myriad of factors from geopolitical events and economic indicators to technological advancements and social trends. As such, it's critical to adapt your diversification strategy to these shifting tides. In times of economic prosperity, when the stock market is on a bullish run, investors often lean toward growth stocks. These are the shares of companies expected to grow at an above-average rate compared to other stocks in the market. They're typically found in sectors such as technology and consumer discretionary, which tend to thrive during economic booms. However, these stocks also carry higher risk due to their volatile nature. On the flip side, during market downturns or periods of economic uncertainty, defensive stocks become more appealing. These are shares of companies in sectors like utilities, healthcare, and consumer staples, which provide goods and services that people need regardless of the state of the economy. These stocks usually offer lower returns, but they bring stability to your portfolio when the market is stormy. It's important to note that while the market's overall direction influences these strategic shifts, it's not a call to abandon diversification. Instead, it's about adjusting the weights within your portfolio. In bullish times, you might increase your allocation to growth stocks, but not at the expense of having all your eggs in one basket. Similarly, in bearish periods, defensive stocks might take a larger share, but not to the point of neglecting potential growth opportunities. Remember, timing the market is a game few can win. Instead, continuous portfolio rebalancing, keeping an eye on market trends, and adjusting your strategy accordingly is key to successful investing. Adapting to market dynamics can be your key to maintaining a resilient and flourishing stock portfolio. So stay informed, stay flexible, and let your diversification strategy be the compass that guides you through the ever-changing landscape of the stock market. Why should your diversification strategy extend beyond stocks? That's a question that often pops up in investment discussions. The answer lies in the concept of asset class diversification, a strategy that can add another dimension of stability to your investment portfolio. In the world of investing, the term asset class refers to a group of similar types of investments. Stocks are one example, but there are several others, including bonds, real estate, and commodities. Each of these asset classes has its own unique characteristics and, importantly, its own risk and return profile. Let's take bonds, for instance. Bonds are essentially loans that you give to a government or a corporation, and in return, they pay you interest over a specified period. Bonds are generally considered less risky than stocks, which can make them a valuable addition to a portfolio, especially during periods of market volatility. Real estate, another asset class, offers a tangible physical asset that can generate income through rent and potentially appreciate in value over time. Real estate investments can provide a hedge against inflation and add a layer of diversification that's largely independent of the stock and bond markets. Commodities like gold, oil, or agricultural products can also play a part in a diversified portfolio. They can serve as a hedge against inflation and a buffer against economic downturns, as their prices often move independently of stocks and bonds. Incorporating various asset classes into your investment mix can help to spread risk even further. While stocks may plunge, bonds may hold steady, or real estate may even increase in value. This balancing act of different asset classes can potentially lead to a smoother, less volatile ride for your overall portfolio. But remember, diversification across asset classes isn't a one-size-fits-all strategy. It's important to consider your own financial goals, risk tolerance, and investment horizon when deciding how to diversify. Broadening your investment horizon to include diverse asset classes can be your ticket to a robust and enduring portfolio. It's not just about spreading your investments, but spreading them strategically to optimize returns while prudently managing risk. So, what have we learned about the art of stock diversification? We've embarked on a journey that has taken us through the intricate labyrinth of stock diversification. We started by laying the groundwork, exploring the foundational concept of spreading investments across different stocks, sectors, and industries. We dug into the importance of understanding individual stocks, their risk profiles, and the correlations between them. We learned that diversification is not merely a spreading of investments, but a strategic approach designed to optimize returns while managing risk. We then delved into the concept of sector diversification, a tool often underestimated, but pivotal for a well-rounded portfolio. We saw how strategically allocating investments across various sectors, such as technology, healthcare, finance, and more, can shield a portfolio from the adverse impacts of a downturn in a specific industry. Through case studies, we illuminated the tangible effects of sector-focused diversification. Taking our understanding to a global level, we explored the dynamic realm of geographic diversification. We saw how spreading investments across different regions and countries can effectively mitigate geopolitical risks and enable us to capitalize on diverse economic conditions. Real-world examples vividly illustrated the resilience gained through a well-thought-out global stock portfolio. We also uncovered the significance of market capitalization in the intricate dance of stock diversification. We learned that from large-cap to small-cap stocks, each plays a unique role in shaping a portfolio's risk and return profile. We were guided through effective strategies for balancing market capitalization within a stock portfolio, ensuring optimal results. Recognizing the dynamic nature of markets, we discovered how to adjust our stock diversification strategy accordingly. We learned how to navigate the bullish exuberance of a bull market and how to weather the storm of a market downturn. The video empowered us with practical insights and adaptive strategies to maintain a resilient and flourishing stock portfolio. But we didn't stop there. We expanded our knowledge by exploring diversification beyond stocks. We understood the importance of incorporating other asset classes such as bonds, real estate, and commodities into our investment mix. We discovered how a well-diversified portfolio across various asset classes can enhance stability and mitigate risks. In essence, we've seen that stock diversification is not a static concept, but a dynamic and nuanced strategy. It requires continuous learning, adaptation, and strategic decision-making. It's an art that, when mastered, can lead to sustained financial growth, resilience in the face of volatility, and a portfolio that not only stands the test of market fluctuations, but thrives amidst them. Mastering the art of stock diversification can be your path to building a robust, diversified, and enduring investment portfolio that thrives amidst market fluctuations. Our video for this week ends here. We hope you learned a thing or two. Stay tuned and subscribe to our YouTube channel. With that, see you next week with another topic. Until then, keep learning, keep diversifying, and keep growing your wealth. Because the art of stock diversification is not just a strategy, it's a journey towards successful and sustained wealth creation.